When most people think about the stock market, they imagine charts climbing endlessly upward, traders shouting on exchange floors, or maybe their retirement accounts growing steadily over decades. But what if I told you that everything propping up this massive financial machine depends on something so fragile, so invisible, that most investors never even think about it? What if the entire system we trust with our life savings is balanced on a foundation that could crack at any moment? When it does, the crash won't just be another correction, it'll be a reckoning that reshapes everything we thought we knew about wealth. The truth is the stock market isn't standing because of corporate profits, economic growth, or even government intervention. It's standing because of something much more precarious, something that has kept empires afloat for centuries until the moment it vanishes. When you see what's really holding this whole system together, you'll understand why the smartest money in the world is quietly preparing for what comes next. The stock market today is not what it appears to be. When you buy shares of Apple or Amazon, you think you're investing in companies that make products and generate profits. And on the surface, that's true. But underneath, there's a vast network of financial engineering that's been inflating prices far beyond what those profits could ever justify. This network operates in the shadows, moving trillions of dollars every day. And it's the real reason your portfolio has grown over the past decade. At the heart of this system is something economists call liquidity injection. Since the financial crisis of 2008, central banks around the world have been pumping money into the economy at an unprecedented rate. The Federal Reserve alone has expanded its balance sheet from under $1 trillion to nearly $9 trillion. That's not economic growth, that's monetary inflation on a scale never before attempted in human history. Where does all this newly created money go? It flows directly into financial markets through a complex web of banks, hedge funds, and institutional investors. These entities take the cheap money from central banks and use it to buy stocks, bonds, and other assets. The result is artificial demand that pushes prices higher, regardless of whether the underlying companies are actually worth more. Imagine a small town with 100 houses for sale. If suddenly 1,000 new buyers showed up with fresh cash, house prices would skyrocket. Not because the houses got better, but because there's too much money chasing too few assets. That's exactly what's been happening in the stock market for over a decade. But here's where it gets interesting. This system only works as long as everyone believes it will continue forever. The moment doubt creeps in, the whole structure becomes unstable, and doubt is starting to creep in. Inflation, which central bankers insisted was temporary, has proven to be anything but. Interest rates, which were kept at zero for years, are now rising faster than anyone expected. And the cheap money that's been flowing into markets is starting to dry up. The warning signs are everywhere if you know where to look. Corporate debt levels are at historic highs, meaning companies have borrowed heavily to buy their own shares and inflate their stock prices. Margin debt, which measures how much money investors are borrowing to buy stocks, reached record levels before starting to decline rapidly. And perhaps most telling, insider selling has accelerated dramatically, with corporate executives dumping their own company shares at rates not seen since the peak of the dot-com bubble. The most dangerous sign of all is the wealth effect. For years, rising asset prices have made people feel richer, even though their actual income hasn't grown. This feeling of wealth has driven consumer spending, which has kept the economy afloat. But the wealth effect works in reverse too. When asset prices fall, people feel poorer and cut their spending, which creates a vicious cycle that can bring down the entire economy. We've seen this pattern before, and it never ends well. From the crash of 1929 to the dot-com bubble of 2000 and the housing crisis of 2008, the mechanism was the same. Easy money flowed into assets, creating artificial demand and inflated prices. Investors convinced themselves that this time was different, and each time, reality eventually reasserted itself, and the crash that followed was proportional to the bubble that preceded it. What makes today's situation different is the sheer scale. Never before have central banks coordinated to inject this much money into the global financial system. Never before have asset prices been inflated this far above their historical norms. The system is showing cracks. Regional banks are failing at a pace not seen since the 2008 crisis. Commercial real estate is showing signs of severe stress, and the bond market, which underpins everything else, is experiencing volatility that suggests major changes are coming. Meanwhile, the very wealthy are quietly repositioning their assets. They're moving money out of traditional stocks and bonds and into tangible assets that hold value regardless of what happens to paper markets. They're buying farmland, precious metals, and businesses that provide essential services. They understand that when the hidden support system finally breaks, the crash won't discriminate between good companies and bad ones. The question isn't whether this system will break, the question is when, and what happens to everyone who isn't prepared when it does. The collapse won't happen overnight, but the process is in motion. Market crashes follow a predictable sequence, and we're witnessing every stage of that sequence unfold in real time. First comes the peak of complacency. Then comes the crack in confidence, usually triggered by something unexpected. Finally comes the rush for the exits, where everyone tries to sell at once and discovers there are no buyers left. We're somewhere between the second and third stages right now. The crack in confidence began when inflation refused to cooperate with central bank predictions. Central banks found themselves trapped. They could continue pumping money into the system and risk runaway inflation, or they could tighten monetary policy and risk collapsing the very markets they had spent over a decade propping up. They chose the latter, and the consequences are now becoming visible. Interest rate increases are the death knell for artificially inflated markets. When money becomes expensive to borrow, the cheap credit that fueled speculation disappears. Companies can no longer refinance their debts at favorable rates. Investors can no longer borrow to buy assets. The entire structure of artificial demand begins to crumble. But here's what makes this different from previous crashes. In the past, markets could fall back on real economic fundamentals. Today, the disconnect between market prices and economic reality is so extreme that there may be no soft landing. Consider the zombie companies that have been kept alive by cheap credit for over a decade. These businesses generate just enough revenue to service their debt payments, but they contribute nothing to actual economic growth. They exist only because money has been virtually free. As interest rates rise, these zombies will start dying off, taking jobs, supply chains, and investor capital with them. The real estate market offers another window into what's coming. Commercial properties that seemed valuable when money was cheap are now sitting empty. Shopping centers, office buildings, and retail spaces that were bought with borrowed money are now worth less than the debt secured against them. The owners of these properties face a choice: keep paying on underwater loans or walk away and trigger a cascade of defaults. Residential real estate tells a similar story. Millions of homeowners bought at peak prices using adjustable rate mortgages or took out home equity loans against inflated property values. As rates rise and home prices begin to fall, many will find themselves owing more than their homes are worth. The wave of foreclosures that follows will make the 2008 crisis look modest by comparison. But the most dangerous bubble of all might be in government debt. Countries around the world borrowed heavily during the pandemic, confident that ultra-low interest rates would make the debt manageable. Now those rates are rising, and governments face the same impossible choice as everyone else: pay crushing interest costs or default on their obligations. When governments start struggling to service their debts, the ripple effects spread throughout the entire financial system. Government bonds are supposed to be the safest investments in the world. If that bedrock starts to crack, everything built on top of it becomes unstable. The signs of stress are multiplying. Pension funds are discovering they don't have enough assets to meet their obligations. Insurance companies are watching their investments lose value as rates rise. Banks are finding their balance sheets full of loans that will never be repaid. Each of these institutions is connected to dozens of others through a web of contracts and financial obligations. When one fails, it doesn't fail in isolation. It triggers a chain reaction that spreads throughout the system faster than regulators can respond. The smartest money in the world isn't waiting for the crash to reach its climax. They're positioning themselves now while most people are still in denial about what's happening. They're buying assets that perform well during financial chaos, precious metals that can't be printed into existence, productive farmland that generates real wealth regardless of monetary policy, and companies that provide essential services people need regardless of economic conditions. They're also preparing for the opportunities that chaos creates. Every major market crash in history has been followed by a massive transfer of wealth from the unprepared to the prepared. Those with cash, when everyone else is forced to sell, can acquire quality assets at fire sale prices. The hidden reason the stock market is still standing isn't strength, it's momentum. Like a spinning top that appears stable even as it slows down, financial markets can maintain the illusion of stability right up until the moment they topple over. The energy that's been keeping them spinning is the artificial demand created by central bank money printing, and that energy is being withdrawn. What happens next won't be just another correction that recovers in a few months or years. It will be a fundamental reset that changes how wealth is created, stored, and transferred. Those who understand what's really happening have time to prepare. Those who don't will learn the hard way that in financial markets, as in physics, what goes up without real support must eventually come down. The question that should keep you awake at night isn't whether this will happen. The question is what you're going to do about it while you still can. The stock market isn't standing on solid ground. It's balanced on a foundation of artificial money that's already starting to crack. The hidden mechanism that's been inflating asset prices for over a decade is breaking down, and when it finally gives way, the crash won't spare anyone who believed the illusion was permanent. History shows us that every bubble ends the same way, not with gradual deflation, but with sudden collapse. And every collapse transfers wealth from those who trusted the system to those who saw through the deception. The warning signs are flashing red. The insiders are already moving. The only question left is whether you'll be prepared when the music stops. If this opened your eyes to what's really happening, hit subscribe. Because understanding the game is the first step to surviving it, and the next phase of this crisis is already beginning.